Hey gang, welcome to Time in the Market, the investing channel with a long-term focus. Taking a look at Roku Inc. this morning, stock was down almost 24% on Friday after their Q4 earnings call, and now they're down another 5% this morning now that Walmart finally announced their acquisition of Vizio, which has been rumored for a week or so, and that gives Walmart access to the advertising space when it comes to the subscription TV model, and that is a direct competitor to Roku. So now you've got another big competitor in the form of Walmart competing with what Roku does. And Roku's main bread and butter is advertising to streaming audiences. So now that they're seeing more and more competition in that space, the valuation is starting to come down as the market worries a bit about what all of that extra competition means. And one of the topics of discussion on their Q4 earnings call was the softness and weakness that's going to continue into 2024 in the advertising space. Now you just add another competitor on top of that, and that's not a good thing. So when you look at this company's history, they benefited a lot from what happened during the pandemic as more and more people stayed indoors, more and more people signed up for streaming services. Those streaming services came to Roku to be an advertising partner. Each time somebody subscribed to one of those streaming services through the Roku OS, that means that Roku gets a cut of that money. Each time a company came to Roku to advertise with them, Roku made money. And that was a really good time for Roku. You kind of see their growth from 18 through 2021 was at a 50% year over year clip. Now that's slowed down into the low teens. And as we look at their actual 2023 results, 11% growth, nothing to sneeze at. But when you talk about 50% growth in the last couple of years compared to 11% growth, clearly a slowdown. Platform revenue up about 10%. We'll talk about what all that means. The nice thing about this company is that it continues to grow, and it continues to grow the number of users on their platform. 14% year over year growth, 80 million active accounts as of Q4 2023, 29.1 billion streaming hours done in the quarter, up 21% over the prior year, same quarter. As you look at their ARPU, though, down 4% year over year. That's a bit of a concern. The average revenue per user coming down a little bit. That it kind of makes you think about whether or not growth is starting to slow without additional accounts being added. You would want that ARPU to continue to grow year over year, especially during the Christmas quarter, which is an important one for them from an advertising perspective, one of their biggest quarters of the year. And a lot of that has to do with the fact that the majority or more than half of their active account growth comes from international markets, which are going to be a lower revenue market than the United States. So as we talk about their actual financials, again, quarter over quarter, for this quarter, growth was 14%. So picking up a little bit over the initial quarters, which is nice to see. Platform revenue up 13%, device revenue up 15%. So let's talk about platform revenue versus device revenue. Device revenue, which has a negative gross margin, so they're losing money on these devices, or essentially when they sell you a Roku device, a smart TV, they've gotten into the smart TV space in the last year and a half or so. They sell you those things, you bring them home, you sign up for a Roku account, you log into your Roku operating system, and you start using that. And that's where their platform revenue comes into play. That's the majority of their business, where they're actually making gross profit, where they're actually making potentially some bottom line money, where they're actually generating free cash flow. This is you going onto that platform, signing up for a streaming service through their platform, them getting a cut of that monthly subscription, them selling you revenue, you using their Roku channel. They have a fast channel, free advertising supported television called the Roku channel that is growing at a decent clip. Them advertising to you through that channel, them doing a variety of advertisements through you, partnerships with brands, etc. And that works for them. That is one of their growth engines. That's where they make money. The problem with the platform revenue, though, is one, these subscription services are no longer in a growth at all costs um, area of their business growth. So when you talk about Disney Plus, when you talk about Netflix, they're not spending as much money advertising on Roku, nor are they spending as much money acquiring users. So maybe less and less people are going to start subscribing to these services through the Roku platform, which puts pressure on growth versus what it was just a couple of years ago. And again, that makes sense as their streaming business matures a little bit. Their growth is going to start slowing down as they get less and less money from these streaming subscriptions that are done through their platform. However, there is going to be some inherent growth here as the prices of those streaming services go up. The cut that Roku gets goes up a little bit as well. So there's some inherent growth built into there as well. From an advertising perspective, When you talk about 2021, 2020, where there are a lot of competitors, if you were an advertiser and you wanted to get eyeballs, if you want to get your product in front of eyeballs in the streaming space, Roku is one of the biggest players in that. Maybe there was some free ad-supported streaming television services like Pluto and Tubi that were growing, but Roku was really the best in play when you wanted that. Now you push forward to 23, 24. Prime Video has ad-supported services now. Disney Plus had ad-supported services now. Netflix has ad-supported services. So a lot of these companies offer ad-supported services now. Now Vizio is getting a huge backing from Walmart, which is obviously going to push their TVs in their stores. And you've got so many more competitors. So if you're an advertiser wanting to get your product in front of streaming eyeballs, you don't only have to go to Roku. You can go to a variety of other spaces. And when they talk about the weakness in the ad market, is it just weakness in the ad market, or is it simply more competitive these days? I think it's the latter more so than the former, because if you look at Facebook, if you look at Google, their advertising is doing fine, right? It's just these TV companies talking about weakness in the advertising space. Well, it's not really weakness in the advertising space. It's probably just the fact that there's 70 different competitors offering advertising supported products these days. And that's a problem for a company like Roku, which is really, really dependent on that. The other problem is this is a almost 3.5 billion revenue per year company, and they're still not making any. So as investors look at how this company is maturing, the question always becomes, when are they going to actually have positive net income? Because yes, your net income is getting better. You only lost $104 million in Q4 against $250 million in Q4 22, but it's still negative at the end of the day. And yes, your adjusted EBITDA is positive, and yes, your free cash flow is finally positive, which I actually like, but this negative number still is going to scare off potential investors. And they're doing something about that. Their top line is growing, and they're cutting back on their bottom line, less spend on R&D, less spend on SG&A, but at the end of the day, even though net income is up 58% year over year, it's still negative. The good thing though is some of that, or a lot of that, is driven by stock-based compensation. There's something like $300 to $400 million in stock-based compensation a year that does flow down to the net income as a loss, but it is a non-cash expense. So on a free cash flow basis, it is taken out, making free cash flow positive. However, you have to consider the fact that that is dilutive in nature to shareholders. So we'll talk about that when I look at my valuation in a second. Then you have the outlook. Again, the outlook continues the kind of lackluster net income expectations from Q4 23. Growth is there, gross profit is there, but net income is negative, and adjusted EBITDA is at zero, which again is worse than they had in Q4 23. They talked about how there's weakness in the ad market. And kind of as you talk about their overall guidance for 2024, one of the things that I didn't like was kind of the overall uncertainty around what they were guiding towards. As an investor, I kind of want to have an idea of what 2024 is going to look like. But they're basically saying, well, continuing our performance from 23, we expect to deliver positive adjusted EBITDA for full year 2024. No mention of free cash flow, no mention of anything like that. No mention of actual margin guidance or things of that nature, which is a bit disappointing. So do I like the product? I love the product. I use Roku's in my house. When I bought a new TV, when I bought a Samsung TV, I tried using their operating system for like a week, and I was like, this thing sucks major butt. And I went out and bought a Roku Ultra immediately. And now I have it on both TVs. I think their OS is the best in breed. I've never actually subscribed to any services through the Roku platform, so I don't know how easy it is. I should probably try that, see how it is. I think the Roku channel is actually pretty good. Had some decent movies there. They've purchased some originals. They purchased all the Quibi TV shows for like less than $100 million after that company spent a couple of $1 billion in order to make that stuff. They have some good home and food content on there. They acquired This Old House and all of the content that comes with that not too long ago. And they've done a pretty good job of kind of building a unique offering that appeals to kind of this like middle class person, kind of like, appeals to me as well. And they had the Weird Al movie, which is actually pretty good. So they don't spend a ton of money on content, but they spend an okay amount of money. Speaking of money, their balance sheet is really, really good. This company's done a good job of actually issuing shares when the stock price was high and not issuing shares when the stock price is low. So now that the stock price is low, they actually have $2 billion in cash on their balance sheet. They're free cash flow positive, no debt, some capital leases, but I think they have the opportunity to buy back shares because of their balance sheet if they feel like their stock price is undervalued. So as we look at the valuation, disclaimer, video is purely for informational purposes only. Do not use this as an investment advice. Do your own due diligence, all of that stuff. So looking at Roku, couple of things to point out. We talked about this in a second ago, but stock-based compensation and stock issuances have diluted shareholders in the last couple of years, so we'll have to keep that into account. No dividend here. We have a pretty good balance sheet, no actual debt, good cash flow on the books. Market cap is 10.3 billion still at the $72 before market opens. It's going to be a bit lower once enterprise value just shy of $9 billion. As I look at my revenue growth projections, I'm thinking it's going to start slowing. That's just the reality of this business. On the other hand, free cash flow margin should start expanding. I'm assuming about 11% growth for 2024 and then starting to slow down to about 8% by 2028. I'm assuming 4.5% free cash flow margins in 2024, up to about 10% in 2028. If you want to play around with these numbers, just hit File, make a copy, and play around with these numbers. I will leave a link to this file down below. As I look at their buyback, you have to assume that their stock-based compensation is going to continue to dilute shareholders. I'm putting negative 50% buybacks, which is about negative $875 million in buybacks. So essentially them issuing $875 million in shares through stock-based compensation. Now that may seem low, given the fact that they issued about 770 million in 2022 and 2023 alone, but I'm also assuming that they're going to institute some sort of buyback to offset stock-based compensation. A couple of years play. If you want to make it higher, you can make it higher, but that is a negative buyback yield. And as I look at valuation here, right now the stock is getting a 1.7% free cash flow yield, mainly because it's not making a lot of free cash flow. In the future, as this becomes a more mature business, as growth slows down, I'm assuming like a 4% free cash flow yield kind of makes sense here. You can go higher, you could go lower as you'd like. But to me, that kind of makes sense when you talk about a mature business that's growing at about 8% when it comes to the end point of the calculation. With that in mind, based off of the $72 price point, I'm only getting about a 4.7% return. That's not very impressive to me. It still feels a bit overpriced, even when you consider the fact that it's down into the high 60s. Unless you think my assumptions here are wrong, unless you think growth is going to continue being into low teens for a longer period of time that I'm assuming here, unless you think that margins at the end of the day are actually going to be higher. That's the confusing thing about the business. That's the concerning thing about the business. They haven't really announced long-term free cash flow margin goals, long-term EBITDA goals. So you just kind of have to assume. You have to think that they're still going to continue to lose money on their devices, but their platform margin is going to expand as this business grows and grows and grows. Is 10% too conservative? Is it too aggressive? I mean, who knows? If the margin ends up being 8.5%, your return's closer to zero. If it ends up being 15%, your return's closer to 14% from where you are right now. So that's kind of the question mark. Where are their margins going to be? If you're an investor in Roku, you kind of have to have a decent idea about that. And I think the market is concerned that even for 2024, they didn't give any clear guidance around what that is. So who the heck knows? That's the issue. Who the heck knows? What's the long-term guidance here? Don't know. Management needs to be more upfront about that, about their goals not only for 2024, but their goals 5 years out. And for me, they haven't been clear enough for me to feel comfortable even around this 10%. So maybe as I look at this 4.7% return, my target return generally is about 10%, which would leave a fair value of about $56, which is 21% off of the $72 price point. Maybe because of that uncertainty, I'd target something like a 15% here, which is a $45 price point. Again, you may think that's just cuckoo bananas, my friend. It's never going to reach $45. Well, it was there like a year ago. It was there. This is one of those markets right now that we're in where growth companies are rewarded really quickly, but they're also punished really quickly. You obviously saw that the stock is down almost 30% in the last 2 days, being punished really quickly. Will that punishment continue? Will the market start to revisit this case, this stock, this case study as something that's no longer a growth opportunity, but more so a value opportunity? If that happens, then a 1.7% free cash flow yield on something that is slowing when it comes to growth, has uncertain margins, might be a bit too rich. And if it starts to come down a little bit, would I be interested in this company? Yeah. I still think when it comes to operating system in this space, Roku is the best in breed. I like their product. I like their offering. It's just that the financials aren't there yet. This is a company that has grown really well, but that hasn't translated to bottom line success. However, I do like what they're doing in terms of moving into the smart TV space, in terms of making more deals with other TV producers to put their OS on there, in terms of the build out of the Roku channel, in terms of some of the acquisitions they've made of content, in terms of some of the acquisitions they've made of ad tech companies that allow them to build out their ad tech business at a really good clip during the times when it was most important during the pandemic. On top of that, they've been smart with their stock based issuances. They issued stock in 20 and 21. I just think that they probably are going to have an opportunity soon to start buying back a bit of those shares. That might be weird because they're issuing so much in stock-based compensation, and most of their free cash flow is because of that. But they have a really good balance sheet. They have a bunch of free cash just sitting there. What are they going to do with it? I think there's some M&A opportunities out there. Are they going to spend more on content to build out the Roku channel a bit more? Um, who really knows? At the end of the day, I think the weakness in the advertising space is kind of them hiding the fact that it's just a more competitive space right now, which is a bit worrying. And I think that's why this stock has to come down a little bit from where it is right now. Fantastic company, fantastic product. Stock price, not really in my wheelhouse right now. I think it needs to be in the 50s for me to start considering it as part of my portfolio. But let me know what you think. Do you disagree with any of my assumptions here? Do you disagree with my thesis on the fact that the ad space is just more competitive now than it used to be? And that really hurts Roku's ability to grow and expand their margins. Because if you disagree, let me know why. Leave a comment down below. I really want to hear what you think about the company from people who may know more than I do. I'm here to learn just as you are. I want to know more about Roku versus what I already know. If you like the video, leave a like down below. Subscribe to the channel if you're new here. But as always, thank you for watching. Let me know what you think. Leave a comment down below if you have any suggestions or anything of that nature. But thanks for watching. Have a good day. Bye.